Hello investors, welcome to Business Learnings. In this video, I am bringing you another potential multi-bagger company, Neuland Laboratories. And there is a reason I feel that this company could do well in the next few years. And the reason is it's a shift in the business mix, it's shift in the revenue mix. So make sure that you watch the video throughout the end. It's going to be a 10-minute video, and do subscribe to the channel. It's very difficult to analyze these kinds of companies in such short amount of time, but I'll still do my best to cover it. So if you carefully look at the chart of this company, the it used to trade at about 128 rupees in April 2005, and for about almost 8 years it was trading at the same levels. The reason was it was still manufacturing generic APIs. APIs are active pharmaceutical ingredients. So whenever you take a medicine, it has various. It's a chemical composition of various kinds of chemicals. The one chemical that actually treats you is the API. Others are just used for formulation for making that tablet, or whatever you call it, capsule. So this company was in that generic API business. The reason that generic API business doesn't reward you much is because anyone with the right equipments can manufacture. It doesn't need much brain power, right? So there is a lot of competition, and the company which can provide its products at the lowest possible price wins, right? So a lot of competition, cutthroat competition, high volume companies, very low margin. And that's why, if you look into the margins of this company, the operating profit margin, you see 9%, 12%, 11%. These were the kinds of margins that this company had in its early days, and this company is there for more than probably 3 or 4 decades, right? Now it about 10 years ago started shifting towards specialty chemicals. The good thing about specialty chemicals is it has a barrier to entry. It has multiple barriers to entry, in fact, because specialty chemicals are very difficult to manufacture. They are multi-stage manufacturing process. The yields are often not that great. The demand is not that high, and that's why it keeps away very big players. And you need to be very efficient to produce these kinds of medicines at scale, because there is a drop. There the yield goes down at every stage of manufacturing a chemical compound. You must recall it from your chemistry, organic or inorganic practical classes from 11th or 12th class, right? So once it started shifting from generic to, they call it GDS prime and GDS specialty. When they started moving from prime to specialty chemical business, their margins started expanding, because when you do not have enough competition, you can charge whatever, and people are willing to pay, because these are rare diseases, and no one else is willing to manufacture. No other, not many companies are willing to manufacture it, because even if there is a slight difference in composition, it could be a matter of life and death. So it has to be very precise, and that's why the margins in these companies are very high. Margins in specialty chemical business is very high. And that's when, the stock prices started surging. So it was about 87 rupees in 2013. It went to about 1534 rupees, about 17-18% kind of 17-18 times kind of growth in just 3 or 4 years, and then it again started going down. So this was the time when this company had a lot of dependency on China for its raw materials. About 60% of its raw materials were imported from China, and that was the problem. When China had put a ban on such chemicals, this company had nowhere to go. So what the management did is they vertically integrated, they backwards integrated itself. So it started manufacturing its own raw materials, right? So the dependency on China is just reduced to 10%, and even for that 10%, it has alternatives available within India. That's a good thing, and that shows the resilience of the management. And there's not just one good quality about the management. The management has multiple good qualities. I'll tell you more about it. In the last 40 years, they have filed numerous DMFs. So DMFs are drug master files. So whenever you want to start selling your APIs in, let's say, USA, you have to get approval from the US FDA. To get that approval, you submit a document called drug manufacturing, uh, drug master file, and it has complete details about the drug, the manufacturing process, how are you going to manufacture, at what scale, everything. So this company uh, has a record. This company has never been rejected with a DMF. Every other pharma company, you name it, and they would be having some molecules which were rejected at some stage or the other. But this company has a track record, a spotless track record of never being rejected, and that's a very good thing, because this builds a lot of confidence of its clients. This is the company which can deliver quality products, no compromises, because it has never been rejected, right? So that has what gave that this quality of this company uh, gave it enough leverage to venture into the CMS business. CMS is custom manufacturing services, where a lot of medical companies, for some specialized kind of API manufacturing, they outsource their manufacturing business to these kinds of companies, or any company which is present in the CMS business. Now, CMS is a very interesting kind of business, and recently this company has been shifting it from GDS Prime, Prime to specialty, and Prime to CMS business. CMS has the most profitable, most thickest margins, and that's why we want more and more revenues coming from CMS, because then the profits increase exponentially, and you get to leverage you get to exploit the principle of operating leverage. Check out the link of operating leverage right here. So while talking about the CMS business, there are challenges on its own. The scientists first have to discover the drug which might get effective in the disease. Then that drug is, it's clinically tried in some animals, and then human trials, clinical trials, one, two, three, and then it reaches the commercialization phase. And until commercialization phase is where the operating leverage plays out, is where a lot of money is made. And this company's specialty is just that it has about 6 molecules in the commercial phase, and it says that in the next 1 to 3 years 6 more molecules are going to come, which simply means that the revenues from CMS business is going to get double. The profits will grow multifold, and that's why we think that this company has a great potential in the coming few years. Now, the reason the CMS business is a very strong business is, once you acquire a client, the client does not shift its providers. If a client signs an agreement with Newland Laboratories, it's likely to stay with it lifelong. The reason being, this company develops the expertise, the manufacturing expertise on that particular molecule. And if the provider shifts its the client shifts its providers, there is a lot of switching costs. The other company has to learn the entire process bottom up, and then start manufacturing, which again, there will be a lot of cost and time delay, plus they'll again have to get the FDA approval. So a lot of switching cost is there. That's why, this is a very CMS is a very sticky business. CMS, or CRAMS as industry experts call it, is a very sticky business. The revenues are lumpy in nature. The reason being, you only started realizing the profits. Profits and revenues start growing multifold when you reach the commercialization stage. There are a lot of APIs which never reach the commercialization stage. Let's say you drug discovered a particular API, and that didn't your clinical trial it didn't pass the clinical trials. You have to check it off from the pipeline. And that's why, once you reach the commercial level, you are set for life. And this company has about 6 molecules, which it is expected to get in the commercial phase in the next few years. And that's a good thing. Another good thing is, this company has been investing a lot in research and development and hiring good scientists. I'll show you the employee cost. See the employee cost. It in March it had grown to about 20% of all its costs, and it has steadily going on, because they are investing a lot in hiring good quality scientists, and investing a lot on research and development, which will help them to generate a lot of revenues and profits in the coming few years, right? So this was all that I wanted to talk about this company. It's a very personally, I'm invested in this company. That's why my views might be biased. So therefore, do your own research before investing. And I would suggest to go through the annual report of this company. It will provide very good insights of how the business is going to unfold in the next coming few years, and whether this company can become the next alkyl amines, or Loras Labs and Divi's Laboratories. So thanks a lot for watching this video. uh, do subscribe. Bye.